Let's now connect with Kumar Palghat, Managing Director with Kapstream Capital, joins us live from Sydney via the Skype link. Kumar, good morning. Thank you for joining us. Kumar, let's start with the data which we've got from China, news which is fresh off the press this Friday morning. The Chinese GDP data, there is a sequential jump of about 2% plus, and looks like China is stable.
Yeah, no, thanks for having me. Look, the China data is not a surprise. As you said, the growth was about 7.8% or a little over 2% for the quarter. Something about the Chinese economy is that they're going to try and keep that growth rate somewhere between 7.5% to 8%. The government's bent on making sure that that growth remains sustainable over a period of time. We at Kapstream, we're not bearish on Asia. We're not bearish on China at all. We think the problems in the U.S. at some point will go away, and I think Asia will start to do better. So the China data just confirms to us that the Chinese economy continues to grow despite the problems that the U.S. faces.
Kumar, what's your sense post the debt deal? Does it seem like we could see a fair amount of money coming into the emerging markets, or do you think now there's going to be a shift and it is U.S. equities which are going to become dearer?
No, I think all risk assets will start doing well, right? The uncertainty was that the U.S. government, has caused some issues of waiting to the last minute to increase the debt ceiling. We know that the problem is going to come again in February, but they have 3 or 4 months to work it out. All this says is that the Federal Reserve in the U.S. will keep money cheap, and they're not going to remove any bond purchases anytime soon. So they're giving you a signal that just says that risk assets you should buy. So you should buy U.S. equities, which also says that money flows back into emerging market currencies, emerging market equities, because the whole entire market's got a relief rally, and you think that should continue for a little bit longer.
Kumar, whereas the liquidity argument for emerging markets is strong, but for emerging markets there are two core concerns, earnings and growth. In the light of poor macro data, do you think emerging markets are unlikely to outperform developed markets in the medium term?
No, we use a broad brush for emerging markets, right? We put all countries in the same basket, and then we talk about developed versus developing emerging markets. But then if you look at individual countries, they have their own issues. Look at India, for example. You run twin deficits. You've got a central bank that's actually fighting a currency that's weakening. You've got issues with interest rates and inflation. India and Indonesia, you could argue, are in a separate basket compared to other emerging market countries. But most of the flows and liquidity flows that you're talking about is driven by cheap monetary policy from the U.S. And in June, July, you had a problem because the Fed was talking about removing this liquidity. So that's why you had an exit from emerging markets, because everybody thought the Fed was going to stop tapering and start tapering and stop buying bonds. So it was a liquidity crisis. Now that's behind us. So I think emerging markets should do well. Fundamentally, they look okay, except for a couple of countries.
Kumar, what's the sense, though, you get on the debt deal? Because most people say that this is pretty much, a short-term sort of reprise, and we could see the government shut down yet again, because Obama's pretty much on a short leash.
Yeah, unfortunately, that's U.S. politics for you, that every 9 months or a year they need to increase the debt ceiling in order to pay the interest payments that they have to pay. But I think what's happened here is the Republicans have really lost credibility in the U.S. by holding hostage health care and Obamacare as part of the bill. What you'll see is you're going to get elections coming through soon where, Republicans might lose some of their seats because U.S. citizens are fed up with the government trying to target short-term things and add other things to it. So it might work in a way that Obama not only ends up having a majority in the Senate, but also in the House of in the House of Representatives. So, look, but this problem, as you said, comes again in February. But hopefully, the politicians know that the markets won't tolerate this every 6 months.
Kumar, the way global economy functions is that America is the core, and that core is held by U.S. Treasury. Given what is happening in Washington, do you think somewhere U.S. Treasury now could lose its reputation of being the safe haven, and that is going to benefit emerging markets and other emerging market debt, bonds?
You're absolutely right on, right? I mean, it's hard to imagine a AAA rated country who's unwilling to pay its debt or come close to not paying its coupon income. So, yeah, we know that the U.S. Treasury market, the Treasury yields are artificially low. Artificially low because not only the economic environment is weak, but also because the Fed is buying bonds. So we know the government's borrowing at teaser rates. If this continues and rating agencies start worrying about the credit rating in the U.S., you'd think rates have to rise. And if rates rise, then borrowing costs go up, which is not good for economic growth. So it's a really tough situation, but I think the market is smart enough and bright enough not to keep funding governments that run large deficits and don't have growth at teaser rates. It's just a matter of when, and that's the Fed's difficulty here, trying to manage that rate rise.
Kumar, good chatting with you. Really appreciate you taking the time out and speaking with us today on ET Now.